Hey, I'm Ben from Modern Graham, and today we are going to talk about Microsoft Corp. I will be giving my valuation of the company, so be sure to stick around and hear what I have to think about this. So, Microsoft Corp has the ticker MSFT, of course, and the price is 241.68. It's in the technology sector and software. I think we all know what Microsoft does. There's a pretty good chance that you are watching this on a computer that runs a Microsoft product. So that is something to keep in mind. But anyway, these items here are from the balance sheet. They're what I find to be most important on the balance sheet. We have total current assets, total current liabilities, long term debt, total assets, intangible assets, total liabilities, and shares outstanding. All of these figures will come into play in the valuation. Over here, we have the chart of earnings, and in blue, you can see that earnings have, over the last 30 years, gone up significantly from where they were 30 years ago. Of course, that is primarily due to this being a tech company that exploded actually in the 90s. I mean, if you look at this, 1993 they had 12 cents per share, and 99 they had 85 cents. That is a pretty significant jump. And then they came down, but then over the ensuing 20 years, they have continued to grow substantially. And then dividends are in red. They started paying a dividend in 2002, and you can see that has steadily grown as well. So that is good to see. Over here, you can see the details on earnings, and this column here is the earnings per share diluted. That's what you find on the income statement. This one here is the earnings per share Modern Graham EPS MG. That is my weighted average of the last 5 years of earnings, which helps to smooth out the business cycle to make it an easier picture on what is happening with earnings over time. And you can see that that has been rising as well. Dividends, you can see, like I said, they started paying, I guess it was 2003 that they started paying, and that has gone up. They've had the entire time they have grown their dividend. So that is really good to see. Every year they grow the dividend. Looks like between 10 and 20% about. In fact, the average, if we take out the 2 years that they doubled the dividend, then the average since then is about 12%. So growing that dividend by 12% every year, that is huge. Dividend yield has actually stayed between 1 and 3% for the most part. It's a little bit lower than that now. Dividend payout ratio right now is lower than it has been in the past. So that might indicate that they have a good capacity to grow that dividend substantially in the coming years here, because there have been years when they've paid out between 50 and 80%. So they do have capacity to grow more there. Now, stage one of the Modern Graham valuation is to determine if the company is suitable for the defensive investor or the enterprising investor. And remember, the defensive investor is somebody who's not willing to do substantial research into a company. So they have very stringent requirements as to what company they will invest in. So first, the market cap has to be over $2 billion. Well, this one very easily passes that. And the current ratio has to be over 2. This one, the current ratio is only 1.84, so it fails that test. Positive earnings per share for 10 years prior, it passes that. It has had positive earnings for a long time. Dividends, it has paid for over 10 years, so it passes that test. Earnings growth, it has had a 250% earnings growth when looking at the last 10 years. So it passes there. PEMG, that is the price to earnings ratio using my weighted average of earnings. That comes to 28.3, which is higher than the defensive investor's requirement of 20. So it fails that test. And the last one, moderate price to assets, it has to have a P/B ratio, the price to book ratio of under 2.5, which it does not, or the price to book times the PEMG has to be under 50, which it is not that either. So if you've been keeping count, it only gets 4 points out of the SIPs that it needs to be suitable for the defensive investor. But what about the enterprising investor? Let's take a look. The enterprising investor is willing to do further research, more substantial research into the company to make sure that it is suitable for that investment type or investor type. And so the tests are not as stringent. The current ratio only has to be 1.5 here. Again, it's 1.84, so we pass that. Debt to net current assets has to be under 1.1. Here it is 0.62, so it passes that. Positive earnings per share for 5 years, it passes that. And it currently pays a dividend, so it passes there. And it has grown earnings. So it scores 5 out of 5 for the enterprising investor, and they might be interested in going further. Now, if you are enjoying this video, be sure to take a moment to like the video. That helps YouTube know who else to show it to, and subscribe to my channel for more valuations. Oh, and also in the description or in the pinned comment, there is a link to a free valuation calculator. So if you like the way that I do my valuations, that is there available for you to download, that you can do some on your own as well. Moving on, stage 2 is a determination of intrinsic value. Now remember, the intrinsic value, what the company is actually worth, is independent of what the market is paying for it. The market goes up and down all the time, and the value is more constant. So we need to determine what it is actually worth to find out if it is a good time to buy. Right now, the valuation formula is taken from Benjamin Graham's book, The Intelligent Investor, and that is value equals earnings per share times 8.5 plus 2 times the growth rate. I use, again, my weighted average earnings to get that, and that's why I call it the modern Graham value formula. But we have 2 variables to look at here. We have earnings per share, so we calculate that using the 5 years here. We get 8.54 and plug that in down here. And the growth, we take the current earnings per share and the one from 5 years ago, and we get the total growth of 155% over those 5 years. We divide by 5, we get 31%. And we have a built-in safety margin here because growth is such a huge variable you don't want to overestimate. So we lower that a little bit. We get to 23%. That's still higher than my upper limit for growth because we're assuming the growth in perpetuity. And I don't think any company, no matter what the company is, I don't think there's any company that can grow more than 15% in perpetuity forever. That just can't happen. So we have a limit of 15%. And plugging that in here, we get a value of 328.74, which is higher, if you look down here, higher than the current price of 241.68. It is, the price is 73% of the intrinsic value, so it is undervalued. You can see on the chart here too, price is lower than value. So it's a good time, or it might be a good time. We'll talk about more of that in a moment. Net current asset value is a floor, and here it's negative, so that doesn't apply. Modern Graham value based on 3% growth. If you assume only 3% growth in perpetuity, that's the value. 0% growth in perpetuity, that's the value. And if you put the price from the market in the value formula up here, and then solve for growth, the market is currently implying a 9.9% growth rate. So if you think the company will grow less than that in perpetuity, then it's overvalued. If you think it will grow more than that, then it's undervalued. That's another way of looking at that market implied growth rate. Moving on, the Modern Graham grade, looking at several other factors to give a grade that can be compared to other companies. We have investor suitability. It scores 1.5 points for being suitable for the enterprising investor. It's 1 point for being a good price to value. It is not trading below its Graham number, so it does not get a point there. It does not quite have long-term dividend growth. The requirement for that is 20 years, so it doesn't get that point. The dividend yield is below 2%, so it doesn't get a point there. It does get half a point for trading at a PEMG below its industry average, and no points for trading below NCAV, for a total score of 3, which is actually a B- grade. Moving on to stage 3, which is further research. So if you've gotten to this point and you've determined that the company is suitable for your investor type and it's undervalued, which is what we just talked about, then you need to do further research to determine if it's suitable for your individual portfolio. Consider diversification or your own goals and things like that. But some things that might be useful for you are like the net current asset value. This one, again, doesn't apply here, but Graham number formula. This is a way that some people look at the value using Benjamin Graham's requirements for the defensive investor and putting it to a number, kind of. So you get a number of 71.46. It's trading above that, so keep that in mind. The PEMG, again, we get a PEMG of 28.3, current ratio 1.84, PB ratio of 10.38, dividend yield of 1%, and 19 years of dividend growth. So it's very close to getting that 20th year. If there's anything else you want me to talk about in this stage, please leave a comment and I might be able to add it to this area. Moving on to stage 4. So now if you've gotten this far, the next step is to determine if you think it is a good time to buy. And we need to look at the market to determine that because we want to maximize our profit options here, our profit. We want to maximize that. So let's switch over to a daily view here. And you can see going back to December, we've been on a downward trend here and established a trend line there that tried to break through, but then it came back down and it has bounced into that a few times. That's what it is stuck at now. And the bottom end of that little channel there is kind of the same thing where it's come down. It has hit that a few times, but it can't break through that. So what I would be watching now is to see if it can get above that trend. Otherwise, it'll continue to come back down and it'll look for support, probably going farther back. Right now, might get a little bit of support from this level here. You can see that dashed line, or it could come back to this point too, or even further down. But there's a lot of spots that it could come down if it doesn't break through that. And right now it's really struggling to break through that point. Even if it does, it'll hit a hard point here. There's resistance at that level. But if it manages to get above its trend line and that resistance level, it could go up further. Down here we can see that it has been in a bearish pattern for RSI, Relative Strength Index, that shows us momentum in the stock. And it had a lot of momentum back here in October of 21, but then it came back down and it dipped below 30, indicating that it was transitioning into a bear pattern. And so now we're waiting to see if it comes up above 70, then it would indicate that it is re-entering a bullish pattern. But you can see it keeps dipping below 30, which means every once in a while it gets a little bit oversold. And then a little after that, it will bounce back up a little bit. You can see right now it has a little bit of upward momentum, but again, it is in a bearish pattern. So I think this is one to add to a watch list, but may not necessarily be a good time to buy right now. So keep an eye on that and click on the video on the screen now to see more stuff from me. But thanks for watching, and I will catch you next time. Take care.